Hey guys, Whitney here. Thanks for joining me today for another Passive Investing Made Simple Masterclass, where we help you put the knowledge of how all the ins and outs of passive investing into use. That way you can confidently make your first or next investment. And I know people are filing in right now, so I'm not going to launch into the goods quite yet, but I just wanted to make sure, we've got our two very special guests on today, Kris, Bennett, and John Allen. They're going to be hanging out with us today talking about self-storage. They are the managing partners for the self-storage here at passiveinvesting.com. And we're going to dig into some fine details, but, before we get started on that, if you're looking for self-storage or are an investor that needs depreciation before the end of the year, I want to make sure that I mention this at the very beginning. Our self-storage fund is open. And the unique thing about this fund is that if you invest in the fund, you actually get to take advantage of all the depreciation for the assets purchased within the year. So it can be a really unique way for you to get an accelerated bonus depreciation if you need that for 2021. Okay. So I'm going to drop the self-storage reserve fund into the chat right now. I'm not very good at doing two things at once, so guys, give me a second to do that. All right. So it should be in there for you guys right now. If that is something that you're interested in, make sure to pop over there. I know it's the holiday season. A lot of people are kind of like, ooh, I'm hoping to spend time with family and friends for the next few days. Super quick to, to fill out that form and get the process rolling, because you do have time between now and the 31st in order to get that investment locked up if that is something that you need. And awesome. Kris has done that too. Perfect. Thank you so much. Well, I would like to welcome Kris and John, and thank you so much for joining with me today. And before we dive into talking about passiveinvesting.com, I'd like to do a little bit of background about your personal journey with real estate. So how did you guys get started with real estate, and more importantly, self-storage?
Yeah. Hey guys. Thank you guys for joining us. It's Kris here, co-managing partner of the self-storage arm of passiveinvesting.com. So I got started, I guess, in real estate in general back in 2007. I got my license at that time, was going to be a broker and in residential and go make a bunch of money and, all that stuff. My broker licensing classes were completely packed out. So everybody had kind of the same expectation. Well, none of us knew what was coming in 2008, right? 2008, 2009. So that was a rough time to be a real estate agent and a broker. We obviously shot ourselves in the foot. The recession came from the real estate industry, so that was pretty rough at that time. Anyway, decided, just kind of fast forward, went to school, decided to get out of real estate. Actually didn't like it because of my experience there. Went to school at UNC Chapel Hill, graduated. But while I was and graduated from there, but while I was in school, I actually found out they have a real estate program within the business school. So that kind of intrigued me. And ironically, the only job I could find my first year there was actually as an intern working for a private equity real estate company that invests in multifamily properties, which I had never really understood or heard of or anything like that. All I knew was single family up to that point in time. So it really opened my eyes to the opportunities, and what he was doing was raising capital within syndications and funds to go out and buy multifamily property. I was like, oh my gosh, you can raise capital and go do this and buy these, like buy 300 units instead of like 3. Like, this is amazing. I had no idea. So I worked firsthand there and then graduated and worked for a firm up in Raleigh. And that's pretty much how I got into storage. I was actually looking at multifamily properties for them. I was their director of acquisitions, which is just a fancy title for bird dog, right? You just go out and look for deals. That's basically it. So that was my job for the first year. And while I was there, but for the first year I was doing multifamily. We couldn't make the numbers work on most of the deals that we looked at. So we pivoted to storage and we raised a small fund, and we decided to go out and buy with the goal of going out to buy mom and pop owned facilities. So like smaller, maybe 30,000 square feet or less, those types of facilities, and turn them into unmanned or automated operations. So that's what we did. First one's very successful. We raised, I don't remember the exact number, but the goal was $10 million. And we completed that fund, and I moved on, moved back to Charlotte, and then partnered up with John. And that's kind of up to this point, that's where we're at. That's how I got into, I guess, the investing side of the business.
Awesome. John, what about you? What led you down the path of real estate?
Yeah, sorry, I was having some audio issues there for a second. Yeah, thanks, Whitney. Thanks everybody for joining us. Appreciate Whitney having us on here. Yeah, so I got my start actually in public accounting. So I was working at a CPA firm here in Charlotte, where I'm based now. And I was focused pretty heavily on real estate clients, figured out pretty quickly that I really enjoyed the industry. I liked how it worked. I liked the opportunities for, building that passive income that I could kind of see, as I was, helping my clients. And I did that for about 10 years. In addition to figuring out that I liked real estate, I figured out I did not want to be an auditor for the rest of my life. So I ended up getting connected with a family office here in Charlotte through a client, and they needed sort of a kind of a hybrid CFO and director of all things commercial real estate for the company. And so it kind of was a perfect fit. So I joined them and I was there for about 3 years. There I was wearing a lot of different hats, had several different divisions of the company that I was managing the finances for, but then also anything that we were developing in the commercial real estate world, any acquisitions, I was kind of running all of that. There wasn't really anybody else that was involved in the real estate side of that business. So that was a fantastic experience. Got to understand the whole development process really well, the whole acquisition process. And it was just a great experience there. So that's how I kind of got started. And then as part of my job there, we did a deal where we invested in a real estate note. And that was my first experience in passive investing. Is the family I was working for, they gave me the opportunity to invest alongside them when we purchased this note. It was sort of a troubled debt kind of a thing that we were purchasing at a discount. That was really the first exposure I got to actual passive investing myself. But seeing how, that was able to create some cash flow, and seeing how that can, apply to other areas of commercial real estate, that's how I got really interested and kind of wanted to pursue that, for the foreseeable future.
Awesome. Awesome. So how did you guys meet, and how did you guys get connected with passiveinvesting.com?
Yeah.
Want to know.
Yeah. I'll chime in here real quick. And sorry, everybody watching or listening. I've been sick for about a day and a half or so. So I'm just put a cough drop in my mouth. So trying to make sure my throat doesn't get super dry and start coughing. But with passive investing, I actually met Dan Hanford. I went to his first meetup that he ever had before he really got started in real estate. Actually, I guess it would technically be the beginning of his start in real estate. So he had a meetup here in Charlotte. I live in Charlotte. John lives on the south side. I live on the north side. So anyway, I went to that first meetup. I actually don't remember how we got connected. I remember receiving the invitation. If it was on Facebook or LinkedIn, I don't recall. But I said, hey, I'll go check this out and see what it's all about. So did that. And Dan and I, and maybe I think it was like 4 or 5 other people, sat around a table in uptown Charlotte and just had a good conversation. So he and I stayed in touch since that time, several phone calls and just, here and there. So we stayed in touch that entire time. John and I partnered up, and he can tell his side of the story too, but John and I partnered up about 2 years ago. John, I was just thinking about this actually today, when that was, and it was about 2 years ago, right in the fall, that you and I got together and met and all that. So John and I were looking for storage deals. We found out we had a lot in common. We met for coffee a couple of times, and we found out we had a lot in common. So we said, hey, why don't we kind of explore a partnership here and look for deals together, et cetera. So we did that for about a year. And then obviously during the pandemic as well, we put 2 deals under contract. So we were working on those 2. One of them fell through because of seller default. The other one we ended up closing with Dan in passiveinvesting.com. Dan called me up in January of this year, 2021, and said, hey, what are you up to? We want to get into storage and love to meet up with you guys and see what's going on. So I said, great, let's do it. So John and I met with Dan and Brandon down in South Carolina, and we devised a plan for world domination in the self-storage industry. And that's kind of where it all began. So about earlier this year, that relationship obviously started years ago, but kind of came to fruition in a partnership earlier this year. So we kind of merged the two, I guess you'd say. John and I came on board underneath the passiveinvesting.com umbrella and closed that first deal back in March, and then launched the fund June, I think it was, of this year.
Awesome. Yeah, I mean, that's what I love about these type of conversations, is that you really get kind of the history around what everybody's experiences that they're bringing to the table, their knowledge, expertise, but also just like the relationships. I mean, you don't go, hey, I found a deal and then start shopping it around and then get into a partnership. Like these things develop over time. And that's one of the amazing things that, we can bring to the table for investors, are those types of relationships, because they take so long to build. And if you're doing it correctly, right? So I want to pivot a little bit. Like when we're looking at self-storage, what is the core investment thesis here? Like, what are we trying to achieve with this type of investment?
Yeah, John, I'll chime in on this one. Some of you guys can probably tell I'm the talker, right? So I talk a lot, and John is the brain. He handles all of our finance, debt placement, closing deals behind the scenes in a sense. So he can talk, but he's more the brain and I'm the mouth sometimes. But I'll let him chime in here too. Yeah.
I always say, if you want the words, you talk to Kris. If you want the numbers, you talk to me. So.
There you go. Perfect. That's great, actually. Perfect. So the question was the investment thesis on storage. Well, I guess if I'm looking at it from a passive investing perspective, forget about storage for a quick second. If I'm just looking at investing in something, and I have whatever the amount of money is, I really don't want to lose that money, right? And so I'm pretty cautious and not nervous, but just cautious and trying to do due diligence on the different options that I have out there. Stock market, the stock market, real estate, crypto, whatever it might be. But I want to make sure at least I get my capital back, right? Like whatever I put my money in, I want to at least get that back. If I make a return, thank God I made a return, and I'm hoping to make a return. That's why we're investing, but at least get my principal back and then return on that investment. So if I look at storage, you asked what our thesis is. Over the last 2 recessions, it's been proven by data to be recession resistant. Nothing is recession proof, but it is recession resistant. It's performed really well during 2008 and 2009 during the first recession, so much so that the government actually started lending through the SBA to people who want to own their own self-storage facility. So that's pretty cool. It's almost like an FHA program, but for storage owners. So that's how comfortable the government, in a sense, felt with self-storage after the recession. And then in 2020, with the pandemic, the same data proved out that storage did extremely well. And in fact, I'll wrap this up here in a second to answer your question. In fact, the Wall Street Journal today, December 22nd, the day of this recording, if you guys go and just Google real quick, Wall Street Journal, WSJ, self-storage, they came out with an article today showing how well self-storage has performed since the pandemic began in 2020, and it has blown almost every other asset class out of the water. So it's not just us saying it. If we say we like storage, invest in it, it's kind of like asking a barber if you need a haircut, right? They're always going to say yeah. But it's good when somebody else, a reputable source like the Wall Street Journal, puts out several articles, including the one today about storage. So to tie it all up, if I'm a passive investor, I want to put my money someplace where I feel that it's secure and that I'll get the principal back and a return on principal. If I'm looking at the options out there, we believe self-storage is a recession-resistant asset class that's in high demand by institutional investors. And that's why we're buying it up to build a portfolio to later on sell or refinance, sell to those institutional investors or refinance for ourselves. So with our investor friends.
Awesome.
So that's basically it.
So why? Like, we can say that it's recession resilient, but why? Why is self-storage?
Right. What are the driving reasons behind it here? Yeah. So in the article, I'll talk about them here in a second. Well, I'll just mention right now real quick. So storage, generally speaking, performs well, whether the economy is up or down, because people need places to store goods and their products, et cetera. When people move, they have to store. Usually they will rent places to store stuff in between their move. If they move jobs, if they get a divorce, if somebody passes away, it's these life changes that kind of drive the demand for storage space. And then you have some businesses that also use and occupy storage. Think pharmaceutical reps, they will store their samples and supplies oftentimes in a climate controlled unit. So it's really life changes, structural changes to our lives that cause demand for storage to exist. And then during the pandemic, it pushed that even further. If you think about people working from home, needing office space, businesses downsizing, they don't want to get rid of all the equipment, so they want to put it someplace to store. If you think about housing for a quick second, a lot of people are being priced out in some of these states or cities where they want to move and they want to live. So they have to move into a smaller home. but they don't have as much space. And so they need to put some things in storage that they can't part with. If you look at places like New York City, it's cheaper to get a 10 by 10 unit than it is to get an extra bedroom for your apartment. So they put stuff in storage as a result of that. So usually some sort of life change, death, divorce, a move, a new job, something like that will drive demand for self-storage as a whole. But then during the pandemic, it actually just kind of accelerated all those things, especially due to job movements and just people moving because they can now work from home.
Awesome. So we touched a little bit on the demand. What is the core investment strategy around, self-storage? And I guess, moreover, like, why would if I'm weighing like two different deals, one's self-storage, one's multifamily, like, what are kind of like the advantages, disadvantages of going into self-storage over multifamily?
Right, like the pros and cons of each one. So they're different because one, in multifamily, you have a longer term lease, right? And so typically you do a 12-month lease. In storage, it's a bit shorter. It's usually a month-to-month lease. So you can take advantage of rental rate increases. You can obviously hedge against inflation if you need to. And then on top of that, you don't evict anybody in storage. If somebody doesn't pay, you just auction their goods off there, whatever it is they have in storage. So you have a lot less heartache, I guess you'd say. When I got my license in 2007 and worked in the industry, I actually worked in the foreclosure business. So I would be the guy that would be the boots on the ground guy that would go with a sheriff's deputy and evict people. Now, I didn't have kids at the time. I was single. If I was married at that time, there's no way I could do that job because I could not kick people out of their homes for non-payment, right? I just can't do that. So, but back then it was a little bit different. So you don't have I guess in a sense, the sad story or look like the big bad landlord, right? When you have to auction off someone's goods, hey, it's just stuff. And usually people just store junk. A lot of the times it's just junk, but other times it is things that are important to them. But usually those people will pay. So if you have to auction somebody, you usually just auction off an old washer and dryer and some old computer and old furniture stuff that they have in storage. So there's a couple of those reasons, obviously. And then obviously we mentioned the recession-resistant asset class. And then lastly, the opportunity to consolidate. So in multifamily, you have, let's just say, roughly 3/4 of the industry is owned. If you drive down the street, you look at a multifamily property, it's most likely owned by an institutional investor or a sophisticated larger group like passiveinvesting.com. Whereas in storage, it's almost the opposite. Only 25-ish% of all facilities out there are owned by the REITs or institutional sophisticated investors. Whereas you could have a really nice facility owned by just a husband and wife team. And they may own just one or two locations. And so you have an opportunity to go out and buy from folks like that. Now, not every deal we buy is from someone like that, but there is a great opportunity there to consolidate within the industry. So we see that as those are a couple of reasons why. John, I don't know if you want to add anything to that I might have missed. And I don't want to talk too much either. So.
Yeah. Along the same lines of, people just storing stuff, people's stuff doesn't call you because their toilet's leaking, or because their whatever goes out. So there's a lot of efficiencies on the management side as well. Now, of course, it is, what we've certainly learned is that it is a retail business. You need to provide a good product for your customers. But from a management standpoint, you don't have a lot of the headaches that you do have to deal with in a lot of multifamily investing.
So let's talk about that a little bit, because I'm sure that kind of leads into the business plan that, within the actual storage fund. What are we looking to do here to enhance these mom and pop properties as we move them into the fund, acquire them and put them into the fund? What's the business plan here?
Typically, it depends on the facility itself. So usually if there's inefficiencies in management, which we'll see pretty often, and John can talk to some of those numbers, but usually inefficiencies in management. And then if we can expand. So we just closed one last Friday that has land to build more storage there. And we also know, just based upon our own due diligence, that there is demand in the market for climate controlled storage. So that's an opportunity there to add value. Typically in storage, typically in multifamily, for example, you think of value add as I'm going to enhance the clubhouse, put in a basketball court, putting granite countertops or quartz or whatever, those kinds of things that actually enhance the life of the person or the tenant living there. In storage, we don't put in granite countertops or like nice gold doors or something like that, right? It's just metal buildings, basically. So the way you add value is by finding, hey, where can we increase the income of the property by either building more, managing better, and it's usually one of those two things, building more or managing better. And then sometimes you can add some parking, that sort of thing where you don't actually have to get into development, but parking as well depends on where the market is. Boat and RV is another big demand driver right now. So sometimes you can add that to a facility if the demand shows that it's necessary. John, if you had any others that you want to throw in there.
Yeah. So one of the ways that we've been able to increase the income and add value in our facilities is on the management side. So the kind of the traditional old school way to do it when you're managing a storage facility is you have somebody who's full-time on site. And if you've ever rented storage before, you can probably understand that a lot of times that person's getting paid a full-time salary plus benefits to sit and check their Facebook for 98% of the workday and talk to a couple of customers, other than that. Well, the way that that storage owners have begun to evolve in that respect is they've set up things like they'll have a kiosk that you can go to. And, on that kiosk, maybe it's a little iPad or something, you can rent a unit there. Well, we go beyond that and we run these facilities unattended. So we will not just have, Kris always says that the best kiosk is the one right here on your phone. Our customers, when they go to our site, if they haven't rented yet, they can pull up, the website on their phone. There's QR codes if they, need it, really convenient like that. And they can rent a unit on their phone, go inside, and they've got a lock, they've got a welcome, thing waiting for them. So what we do though, when we transition these facilities to unattended, like what I just described, is you're going to save on the payroll cost dramatically. So we go from having a full-time on-site person to we have a part-time person that's visiting the property regularly, to check on maintenance issues. If there's any tenants who haven't paid that they need to be overlocked, he'll do that. But we don't have somebody who's working there 40 hours a week and really only working, maybe 30 minutes a week. So that's one way that we've been able to improve efficiencies and add value to a lot of these.
Thank you. And so for the investor that doesn't know what overlock means, can you define that?
Yeah. So most of the time on a storage unit, you've got, your roll-up door there, and there'll be a little slot where you can have your own lock. And then there'll be another one where you, as the owner, if somebody hasn't paid, you can put your lock over that, and then they won't be able to get their stuff until they pay their bill.
I'm sure that's very effective.
Yep.
Awesome. Okay. So, what markets are, you primarily looking in to acquire these assets?
We describe it as growing markets in business-friendly states. That's the easiest way to say it. So if you think of the Greenville, South Carolinas of the world, some markets, obviously Orlando, Tampa in Florida, Atlanta, that's in the submarkets around Atlanta in Georgia, Dallas, Fort Worth, Austin, Texas, Knoxville, Tennessee, we'll look there, Nashville, Tennessee, Denver, Colorado, those types of markets. We won't generally speaking go to any sort of rural or tertiary markets unless we feel really good about them and know them really well, but we haven't done that yet and we probably won't. We get sent deals all the time, and that's the first thing that we look at is where is it located, what market is it in, and then from there we dig a little bit deeper if it kind of checks those boxes. So the ones that kind of grab the headlines in the news where housing growth is booming, population is growing, those types of markets are the ones that we're going to be invested in.
Awesome. So then that leads me to the deal. What specific, criteria are you looking at that makes a good deal?
Yeah, on the deal size, we want to get to an institutional quality size deal, which is usually 40,000 square feet and above. In storage, everything is based upon square footage versus per door. So some people who know multifamily, they understand the per door, but it's usually on a per foot basis. So 40,000 square feet, that's plus or minus somewhere in there around 400, maybe 500 units. It depends on the unit mix, of course, but right around there somewhere. We want to go bigger because you can get obviously a lot more efficient with our management style and what we're doing with those facilities. And then when we're always thinking about the exit, right? So whenever you buy a house, you should always think about who will buy this house for me when I want to move. That's how you should think if you're going to buy your own house, right? Because you probably won't live there forever. So the same thing in storage. Who's going to buy this deal from us? Who is the exit to when we're going in? And it has to make sense. We usually want to look on Google Maps. If they send us a location, we'll check out the demographics, all that kind of stuff. And then I want to see, are there any REITs around? Or do we think it's a market where a REIT will end up being? And it doesn't have to be all the public REITs. There are some private companies and institutional investors that we want to kind of exit to or are thinking about as well. So good growing markets and business-friendly states. The size of facility needs to be institutional quality, which meaning about 40,000 square feet and above, or plus or minus 400 units and above. It does not have to have land to expand on. That's okay with us. But we're also looking, not only can we buy just one in that market, but is this a place where we want to plant a flag and buy 2, 3, 4, 5, 10 more to build a portfolio in that market? Is this where we want to be for the long term, in other words? So we take all those things into consideration, even.
Oh, I think we lost Kris.
Uh-oh.
Oh, he's back.
He's back.
Yay. So we lost you a little bit. You said, if this is a market that we want to plant a flag in, maybe buy like 2, 3, 4, 10 more. And then we lost what you said after that.
Oh, got it. So in the long run, do we want to be there? And do we want to build a portfolio in that market where we have maybe 10 facilities and we can exit to somebody who will buy those from us? So that was it. Sorry, I'm not sure what happened, but sorry about that.
No worries. So I guess that's the question that I had, like on the exit, especially when you're dealing with a fund, like how does an investor experience an exit in this? Like, what does that look like?
Yeah, John, you want to take that one?
Yeah, sure. So we have our, equity that we are raising. Our fund is still open, as Whitney and Kris mentioned, and there's the link there. As our investors, send in their capital, we are placing that in a series of deals that Kris and I are going out and finding, and we're arranging financing and everything. And as we implement our business plan, we will eventually exit, when that business plan's been fully implemented and we are at, in a good spot to sell. And so when we will sell, we are, like Kris said, we're in markets where we don't want to sell to a mom and pop. You can go to a rural tertiary market, and you can find owners there who they know everybody in that town, and they provide this incredible personal connection. But that's who you're going to be selling to if you buy in that market, and you're probably not going to get the highest valuation selling to that person. So that's why we were looking at markets where it's going to be more of an institutional investor exit. But yeah, once it happens, so we will, everything will get, paid off. The loan will get paid off. The investors will get their money back, and they'll be able to participate in the upside, in the capital gain there on the deal.
Okay. So just to sound this back, like an exit could be like individual asset, or it could be like multiple assets rolled into one. Is that correct?
That's right. That's right. Yeah. Misunderstood you, I guess. But yeah, so we are, it's great when we can have deals that are very centrally located in a market. A lot of times, we'll be getting ready to close a deal, and Kris and I will just kind of talk about, this would be a great one because we could sell these later as the Charlotte portfolio, or the South Carolina portfolio, or so yeah, that opens up a lot of doors for you in terms of exit options. So yeah. Just an example of that, we own the first two that we did are up in a town called Mebane, which is about 25 minutes west of Chapel Hill, North Carolina, and it's a booming area. Actually, Alamance County is right there. It's right next to Alamance County, which is one of the top, I think, 5 or 6 places to live in the U.S. according to the Wall Street Journal and Realtor.com. So it's crazy. It's a little like sleeper town that you wouldn't think of, but it's booming there. We have those two that we've purchased with the fund, and then we have another one under contract kind of near there. So could we take those 3 to market as our Piedmont? That area is known kind of as the triad, the Piedmont area. Can we take those to market as our Piedmont portfolio? Absolutely. And those are all institutional quality deals that were formerly managed by Public Storage, CubeSmart, and Life Storage, 3 of the REITs. So is that can we exit that that portfolio really nicely to maybe one of those REITs? Why not? Absolutely. So that's kind of proof in the pudding of the concept.
Awesome. So we're, it's the end of 2021. The fund opened January last year. Can we talk about, and that's usually, I think when I've talked to investors about funds, they're like, being an early adopter, sometimes you get rewarded for that, but also you don't get to see the assets that are in the fund in order to be able to understand, all you have is the thesis to work off of. Let's talk about some of the assets that are currently in the fund. Can we do that?
Oh yeah,
And how
absolutely.
they're performing? Yeah, let's talk about it.
Yeah. So those three that I don't have all the numbers off the top of my head, but John might. So those three, Mebane, we have the two there. We bought the one that was in lease up. I think it was around 30-ish% occupancy. Oh, and I forgot to mention, that was one of our strategies as well. So we'll buy deals that are in lease up, as long as the market makes sense, right? Because if it's located in the right place, the market will obviously typically take care of the remaining occupancy and lease up necessary. So we purchased that first one in lease up. There are about 500 to 1,000 homes going in or to be developed right around that property. And then we have the CubeSmart one that's about 3 miles west of that location. It was CubeSmart, and that has some retail on the first floor as well. That one was a stabilized property. I think that was at roughly 85-90% occupancy on that one. The Mebane deal, the first one, was around 30% occupancy when we closed it. And then we just closed, last month we closed one in Arvada that was in lease up as well at 70%. So we just closed that one. There isn't too much of a change there right now, obviously at 70%. And then the one we just closed last week, actually last Friday, is in Mint Hill, which is Charlotte, basically, of North Carolina. So that one is right about 90-ish% occupancy. I think they only had 5 empty units at closing. So right around 95% occupancy, let's say. So the first two, we could probably speak to that a little bit better than the last two because we just closed those two for the fund.
Awesome.
But yeah, go ahead.
No, well, the question came in and I think we've kind of teased out the difference between a single asset entity versus a fund. But with the single asset property, you're just buying one property, that's it. With the fund, there's the opportunity to acquire multiple deals with the capital that's being raised. And so what that, for me, from the passive investor standpoint, I love that because I am now diversified. Say I invest $200,000 into the fund. Instead of just being in one deal, I'm diversified over multiple deals in multiple markets. And so I'm lowering my risk profile potentially over that.
Absolutely. Yeah, I think we like the fund model. There's always pros and cons to everything, right? So there's pros and cons to storage, pros and cons to multifamily, pros and cons to funds and syndication. We found that when we looked at the the fund model for self-storage, it helps us be competitive. So on the acquisition side, to get good quality deals, usually not all the time, but usually those are controlled by a broker, typically. And so when you go to the broker and say, hey, we have investors that are partnering with us in a fund, we have a fund model, it gets us almost elevates us above anybody else who's using a syndication model. So because in their minds, they know, okay, Kris and John or passiveinvesting.com has the money to be able to go out and buy these deals. So it makes us more competitive to purchase within the space. From the investor perspective, as a passive investor, yeah, if I put in $500,000 or whatever the number is into this fund, I know that I now own a deal, a portfolio of properties just outside of Chapel Hill, North Carolina, another one over in Denver, Colorado, and another massive one in Charlotte, North Carolina. These are all properties or locations or cities that I'm proud to tell my friends and family I'm a part of these deals in these great markets, not in Timbuktu, down in, wherever. So it gives the investor fantastic diversification as far as markets are concerned, obviously the properties as well. So.
Awesome.
Yeah, and Whitney, you nailed it with the diversification. A lot of financial advisors out there will tell you to diversify, and what they mean by that is you should buy, you should invest in your 401k, you should buy, annuities, you should invest in all these different things that you don't know anything about. We believe, diversify, yes, but do that inside something like real estate, because there's so many great advantages to real estate as an asset class, but you're able to, yes, you are diversified in an asset class that you like and that So.
Awesome. And the question came in, how does this differ from a REIT?
Oh, a REIT is typically you have to have at least 100 investors, and it's going to be tax advantaged, right? Of course, so you have to return distributions to investors, et cetera. We're not a REIT. We're not set up that way as far as a tax perspective. You have non-public and publicly traded REITs. Public REITs like in storage, like Extra Space or public storage, et cetera. So we're not set up that way as a REIT per se. So John is a tax guy, CPA. So I'll let him chime in on that if I missed something.
Yeah, the other thing I'll say too about REITs is they have a different investment strategy than we do. They're not going to get you the returns that we are underwriting, when we're going out and looking for deals. They're okay, paying their investors 2%, 3% because that's all they need. It's a very, very, low risk, very low return profile that they are offering. So that's another big difference between what we're doing in a REIT.
Cool. So there was one thing here that I wanted to tease out, and we haven't mentioned that, is the taxes or the tax advantages on self-storage. As I understand it, since it's a commercial business, the tax depreciation timeline isn't 27.5 years like it is in multifamily, but rather 39. Correct?
That's right. So anything that you're not able to, maybe I should back up. So each one of these that we purchase, we have a company that will do a cost segregation study for us. And if you're not familiar with that study, a cost seg study is when they will come in and they will look at all the property, and instead of saying, okay, you bought this land that you can't depreciate at all, and you bought this building, which you can depreciate over 39 years, they'll say, okay, you bought this land, but you also bought, this fence that you can depreciate over, maybe that's 5 years or 15 years. And you bought these improvements to the parking lot. And what they're doing is they're segregating as many different assets as they can into shorter term depreciation categories. So they'll come in and, we'll pay them, a fee to do that study, of course, but it's well worth it because we will end up being able to accelerate quite a bit of depreciation when we do that. But yes, Whitney, you are correct that's one difference between multifamily and other, commercial real estate, is that with multifamily being residential, anything you can't reclassify into a shorter term depreciation life is going to be your 27.5 years. Whereas with other commercial like storage, it's the 39 years. But yeah, that's why we always do a cost seg study so that we can have as little of that be in the 39-year category as possible.
Awesome. So we're still able to, as investors of, in the fund, we're still able to take advantage of like the bonus depreciation, accelerated depreciation.
That's right. Yep.
Awesome. All right. I would love to just, we're kind of deep in on the time schedule here, but I want to, there's several questions that have come in around the specifics of the fund. And I would love to kind of pitch these out to you guys. Let's answer what we can in a broad audience. If we can't answer it live, I can definitely, get the answers for people and send it back. But one, like how are returns, how are the return structure handled here and distributions for the fund?
Yeah, so the returns, we're paying distributions monthly. So if somebody invests they send us their capital, in December, it gets invested, the following month, so January, and you would get your first distribution, your January distribution you would receive in early to mid-February. So their monthly distributions is the way that the fund works.
And is there a preferred return,
There is, yes. So the preferred return is 7%. And once we return that plus everybody's capital, then we as passiveinvesting.com will have a 30% promote that we have on the back end.
Okay.
But yeah, 7% pref.
And then how is reporting handled? Because I know sometimes with funds, they just like say, oh, here's the overall performance of the fund. Other funds, they're like going down to the individual asset level. How is the reporting being handled here?
Yeah, so we drill down more into the asset level. So we'll have, and we kind of give different levels of reporting at different frequencies. So for example, what everybody will receive every month is they'll get an investor update that will describe, the occupancy of each of the properties. If we've got some where we are expanding, we've got some development, on-site development going on, then there'll be an update on that. Where are we in the process? What's the work being done? Hey, here's a few pictures of the work that they did this week. And then, so that's more your high level, reporting. And quarterly, we post in the investor portal some actual property level financials, a rent roll, showing all the tenants and all the occupancy and everything. So yeah, different levels at different times, but yes, we do get down to the individual asset level. So.
Okay, awesome. And then I had a couple questions come in. Are we accepting any sort of 1031s into the fund?
Yeah, so we can work with investors who have 1031 money. It's a little bit of a different animal. The money would not get invested directly into a fund. It would be what's called a tenants in common structure. If you're not familiar with that, sometimes it's referred to as a TIC structure, and it's probably beyond the scope of what we're talking about now. But I guess maybe the short answer is yes. If you have 1031 money that you're interested in investing in storage, we can absolutely accommodate that, especially if you have a larger dollar amount where it makes more sense to go through that process. So yeah, that's definitely a possibility.
We just did that on the deal we closed last Friday. So absolutely.
Awesome. I'm sure that's a massive advantage here. And so, guys, reach out to us if you have 1031 funds, especially like a large amount, like, $1 million more, I would imagine, that it tends to make better sense at that point in time. But I know several investors that have repositioned buildings this year. So, and are scrambling to try to find that placement. And I know you only have 45 days to reach out to us on that. All right, guys. So I know we have so many other questions coming in, and I wish we could get to them all, but I'd love to transition us to another part of the show where if there's one thing investors should take away from our discussion today, what would it be?
Oh boy. I think one is do your research and understand the pros and cons. I'm just thinking back to the beginning of the interview. The webinar where we talked about why storage, what's our thesis, markets, those sorts of things. Those things are going to be really critical, right? So you want to make sure you understand what you're investing in. Warren Buffett talks about that, like don't invest in anything you don't understand. So if you don't understand NFTs, don't go buy an NFT, right? If you don't understand blockchain and Bitcoin, don't do that. If you don't understand storage, do some research. Obviously, go back and find some non-biased research on storage. So don't take our word for it. Go out there, look at that Wall Street Journal article, pick up the Self-Storage Almanac. Believe it or not, there is something called the Self-Storage Almanac. You can go and buy that. It'll tell you everything you'd ever want to know about the self-storage industry and get yourself educated on it. And then obviously partner with somebody that you know, like, and trust within the space.
Awesome. John, do you have anything to add?
Yeah, at the very end of what Kris said is what I was going to focus on, is do the due diligence also on who is sponsoring the investment, who's doing the boots on the ground work for you. That person needs to have a strong track record in business, preferably a strong track record in real estate. If you're turning over your hard-earned capital to somebody to earn a return for you, you want to make sure that you're putting that with somebody that you can trust.
Absolutely. Yeah, I always tell investors it's the team that earns the returns for you, not necessarily the deal, because the team is what's driving the investment. You're investing in an operating business.
That's right.
So,
yep.
I would love, think personally, let's get you guys out of self-storage. What is your best piece of investing advice that you can offer our listeners today?
I think for me it would be have patience. Because these things take time. It took time for John and I. We met a couple of times at a coffee shop over at Starbucks over in the north side of Charlotte. Got to know each other over time, and we felt comfortable working with each other. And we did that first before we joined PassiveInvesting.com. So we had gone kind of through that whole process, and it took time. It took about a year or so, and to kind of really bring it all together, So I think have patience, and then also look for people to network with, get educated. Some of those things that are just kind of basics, sometimes we want to go out there and rush ahead and move the process along quicker. but we're going to make some mistakes as investors or as just people, right? So have patience with both yourself and the process, and realize that it takes time to either find a good partner or build a good team, or to partner with a company like ours, or, and whatever it is that you might be doing. It just takes a little bit of time and patience. So that's all I think I would say.
Yeah. And I would say along that same line, but take action. It is going to take longer than you think it's going to take to, find your next investment, whether it's passive or otherwise. And if you wait until, you feel like it's a better time in your life, or my favorite one is you wait until the market cycle is changing in real estate, you'll never do the deals that you need to do to reach what your investment goals are. There's a lot of people out there that are waiting to get into real estate, until the time is right. And, you need to be, doing your due diligence, like we said, and you want to make wise decisions, but nobody's got a crystal ball. If you wait until you are going to be able to get fire sale prices on real estate, it's not going to happen. And people can stop saying that it's going to happen.
Oh my gosh, if I could have $1 for every time I heard that. Yeah, I'm going to wait till it all drops. Like, okay, well, it dropped last year. What happened? What'd you do?
Yeah, exactly.
I had a portfolio of properties that I sold in Indianapolis almost 2 years ago. I thought we have to be at the top of the market.
Yeah.
I reluctantly looked up the prices on those properties last week, and I was just like crying.
Yeah.
But how did I know? Right. I had a plan. Yeah. It's
at the time, it's the best decision that you can make. Right. So,
yep.
And that's what you have to do. So that's, I second that with John. Like, that's actually really important. Sometimes I can be, even though I talk a lot, I can be over analytical. Really, I can be. And so it does take just taking action and doing it, and getting punched in the gut a couple of times, and then just keep going. Because if your thesis is right, if those, things check out, like, okay, I'm doing the right thing. Are we looking at the right assets? Yes. We'll keep going, take action, don't give up, and be patient. So.
Absolutely. Well, guys, thank you so much for joining me today. It was such a pleasure. I'm so glad we got to dive into your backgrounds, as well as our investment thesis here at passiveinvesting.com around self-storage. If you guys are listening right now, be sure to register to get access to future masterclasses at passiveinvestingwithwhitney.com. Also, I wanted let's call attention. If you guys have fun, if you're looking for your next investment right now, self-storage is the thing for you. You need to take advantage of losses before the end of the year. Scroll up to the bottom of the chat or top of the chat. I'll make it easy. I'll dump the form in there again. Check out the passiveinvesting.com self-storage fund. This could be a good fund for you. We can hop on the phone before the end of the year and get your questions answered. Kris, will you double check me? Is that the right link?
That's it. Yep, there it is.
Awesome. Well, guys, join me next week. Next week, we are talking on Monday. Yes, Monday, the day after the holiday weekend. But we're talking next week on Monday on how to underwrite a multifamily deal. And you guys have a happy holiday.
Thank you, Whitney. Thank you, everybody. Thanks for tuning
Whitney.
in. Appreciate it. You guys have a great Christmas.
You too. Bye.
All right.
Bye.